Welcome to the Money Runner. I'm David Nelson. It is Friday. It's April 4th. It's about 7 o'clock here. I've been really going through the charts, looking at what took place today. I think the velocity of the decline over the last couple of days, pretty uncomfortable. Certainly not what we expected, at least at the start of this week. We've been here before. We'll likely be here again. You look at this chart on your screen right now. This is the S&P 500 going back some, I think, 85 years here, 1960 to today. A lot of significant drawdowns, and yet the markets find a way to push higher, and they will again once we're beyond this. So, what is causing it? What's the reason for the concern this week? Why the acceleration? Why the velocity that is not unlike what we saw during COVID? Well, it was about tariffs this week. And I guess over the last number of weeks, the markets have been trying to discount how high were the tariffs going to be? How high were the tariffs that the Trump administration were going to put on in escalating what is really becoming a trade war? The thinking was, coming into this week, probably somewhere maybe 10%, maybe a little more than that. That was the thinking. And that's significantly higher than where we are now, because remember, the rest of the world tariffs the United States far more than we tariff them. But that was the thinking coming in. And what we got was, when you do all the numbers, and you can see this up on your screen right now, you can see the tariffs that we're putting on. All in, when you average it out, it probably comes to somewhere around 18%. That's significantly more. And that rattled the markets pretty heavily. So you saw a big sell-off on Thursday, the day after these tariff announcements were made, and a continuation of that on Friday, closing at the lows on Friday, in what was kind of a capitulative day. And maybe there's some good news on that. I'm going to talk about that in a second. So why is the administration doing this? And again, this isn't for or against the administration. I certainly want to see something good come from this. So why is the administration doing this? Well, it really goes back to the piece that I put out earlier in the week. It was kind of a white paper on tariffs. And Donald Trump, and he's been saying this since the 80s, he wants to disrupt a trade system that's been in place really since about 1944. And back in 1944, we had the Bretton Woods Agreement. And at that meeting with world leaders or the designees of world leaders, a lot of our trade structure that we have today was really established back then. And the thinking was the United States came out of World War II as the strongest economy on the planet, and we certainly were. And there were a lot of war-torn nations, and the thinking was that the United States, being as strong as it is, could afford to let other countries tariff us, which is a tax, it's a consumption tax, to tariff us more than we would them. And in the long run, we benefited from it greatly, as did the rest of the world. It helped us sell our goods and services around the world. It helped these economies repair. Certainly Germany needed that. Certainly most of Europe did. Japan, of course. And over time, these economies became stronger and stronger and stronger, and became very, very competitive. In some cases, very competitive. All of these economies have strong technology presence. They have become industrial powerhouses. Certainly Germany was that. Japan in the 1980s. And of course, China is the second largest economy on the planet. They export to the entire world. We have a massive trade deficit with China. So certainly it benefited all these economies. The United States is struggling right now, and I think the feeling in the administration is, given that our debt and deficits are as large as they are, that they heed some of the cautionary things that hedge fund guru, Ray Dalio have said, that the United States could be on the verge of a financial heart attack if we don't do something about that. So that's their thinking. Whether you agree with that or not, that's their they're thinking. But I don't think that's the only reason the markets are down. I wish it was that easy to say, because I think in the end, world leaders will get together and solve this. We are the consumer to the world. They need the U.S. consumer to run their economies, and we need them. Everybody needs to work together. And at some point, despite how dark this seems right now, I think that will happen. But I don't think that's really the only reason for the decline. And it kind of all came together to me. And a good friend, Dan Niles, who worked at Lehman Brothers around the same time I did, pretty bright guy. And I was reading some of the things that Dan had talked about. I think there's also something going on here that we need to at least acknowledge, that the U.S. stocks were pretty expensive. Now, we pay a premium for U.S. stocks because most of the technology on the planet comes from this country. Most of the scientific innovation comes from this country. We have the rule of law, so we pay up for stocks. But sometimes that can go too far, and maybe that's what happened. That's what happened this year as well. You need a trigger to unwind these things. And first trigger that I remember really was the DeepSeek moment that we saw a couple of months ago. And back then, DeepSeek, which is a Chinese startup, had announced that they had built a large language model at a fraction of the cost that large hyperscalers here in the United States had done it. And that sent tech stocks reeling. On that day, NVIDIA and some other stocks in the same category were down as much as 17% in a single session. Now, they recovered from that, almost getting back to the highs, but it kind of opened up the idea that maybe we were overbuilding in technology, and maybe we didn't have to spend as much on data centers. And in fact, very recently, we've seen some companies that have data center exposure. They've been some of the hardest hit stocks out there, especially if they had exposure to China, which I'm going to get to in a minute. So that was a seminal moment. And that, in conjunction with the tariffs, is probably part of the reason the velocity of our decline has been as high as it is. I think it probably would have been half that if our markets were a little cheaper. And we had not banked so heavily on a very important trade, the AI trade. Now, make no mistake, not backing away from artificial intelligence. It's going to revolutionize our economy. It's going to change the industrial complex. But sometimes you go through phases, and you go through phases where you're overbuilt or you've taken stocks too high, and maybe that's exactly what's happened. And we've seen a pretty significant correction, and we're just one step shy of a bear market. The only good news I saw in the market today was maybe the first signs of capitulation. And, the last couple of weeks we've seen investors rush from one side of the lifeboat to the other, looking for a safe place to hide. So many have been hiding out in widows and orphan stocks like AT&T, Coca-Cola, Procter & Gamble. Today, nothing worked. As a matter of fact, I have one stock on my screen that was up today, and that was a home builder, and I'll tell you why that was. The other reason I can tell that we're starting to get to a capitulation phase is I look at the VIX. Now, the VIX, and you're seeing it up on your screen right there, is a measure of implied volatility. And it's not often that you get above 45. When you get above 45, you're generally a few days away from some kind of capitulative low. Last time we saw something like that was, we're starting to get the levels that we saw in COVID. We had one a couple of months ago. We had one in August. But it's usually an indication that we're starting to get washed out. The tough part is the last couple of days to that washout could be pretty significant in there. So the timing is not easy. So it doesn't mean the downside is over. In fact, I suspect that Monday will be, something of a continuation of today to wash out the sellers that didn't get everything done that they wanted to do. The other news that's out there right now, and the other indicator that I monitor closely, is of course rates. And rates have been coming down all week, meaning bonds have gone up. And that can act as a tonic for the economy. But it's a double-edged sword, because while it can act as a tonic and is certainly a boon to some industries like home building, which is very, very important to the economy, because remember, your mortgage rate is set by the 10-year rate. It's also an indication that the economy is slowing, and I suspect that is the fact. I also suspect that the Fed is going to be cutting rates, and that's not something we could have said a couple of weeks ago. Now, Jay Powell was out as early as today saying that he's in no rush to do anything. The market says otherwise. In the end, Jay Powell will follow 2-year rates. He's been doing it his entire career. I don't think that's going to change now. And if you look at this chart right now, you can see 2-year rates are falling pretty quickly. An indication that we're going to have some rate cuts. Right now, markets are pricing in about 4 rate cuts, which would equal about 100 basis points of cuts between now and the end of the year. So again, everything is pretty fluid. I'm going to have to, put pen to paper, of course, over the weekend and dig down. But I wanted you to get something, as you started off the weekend, to get a sense of my thinking and some of the things that I'm watching. Again, if you want to learn more about yours truly, or more about the Money Runner, go to my Substack site, DCNelson123 at substack.com. I'm David Nelson, and this is the Money Runner.